Hello, everyone. Mark Herndon here, Chairman of the M&A Leadership Council. We'll be starting right at the top of the hour. Welcome to the webinar. And with that, hello again, everyone. Welcome to M&A Market Outlook from Full Stop to Full Throttle, presented by the M&A Leadership Council and our outstanding panelists and sponsors and partners. Again, my name is Mark Herndon. I serve as chairman of the M&A Leadership Council, and we're delighted to honor these panelists today with sharing their insights, their expertise, and providing active guidance for deal makers and executives across the M&A community. In March of 2020, the M&A Leadership Council was among the first to launch survey-based research on the anticipated impact of COVID-19 on the M&A markets going forward. And while every deal maker anticipated an increase in deal activity in the last half of 2020, no one could have anticipated the incredible race to the finish line to get as many deals as possible to the checkered flag by the end of the year. And yet that's exactly what we found. So what we want to do in our discussion today is provide insight on key data points, trends, insights, and applicable intelligence that you can use going forward in 2021. We'll also pivot to pick up those same kinds of implications and market insights to support your active deal strategies and execution. As with every M&A Leadership Council webinar, we look forward to an active Q&A session at the end of this time. And while we won't be mic'd for participation today live, in the interest of time, we welcome you to join in a question through the chat box or the question panel that you'll see at the right-hand side of your GoToWebinar panel. So with that, let me introduce our outstanding panel that we have to work with today. We truly have some deep expertise, and it's an honor to have each of you here with us today. Starting first with Tom Kane, Managing Editor of the Americas with Mergermarket. He leads not only editorial operations for Mergermarket, but also Deal Reporter, a sister publication. In that role, he oversees and supervises 50 different reporters that specialize in M&A and capital markets coverage. And prior to that, Tom served as Deal Reporter's Asia editor as well as European deputy editor. Now, Tom, you and your organization have served for many years as a partner and sponsor to the M&A Leadership Council. We always enjoy working with you and learning from your deep insights. So thank you again for your partnership and your presence here with us today.
Thanks, Mark. It's a real pleasure to be here this morning.
Fantastic. Heather West serves as Senior Editor of the Americas with Mergermarket, where she oversees the strategy for content in the West Coast and Latin America regions. She's held similar editorial leadership roles in New York, Hong Kong, and San Francisco, and she has specialized in identifying early-stage M&A opportunities for the financial, legal advisory, private equity, and corporate development communities. She's got deep sector expertise in energy, consumer products, and technology, media, and telecom. She holds degrees from the University of California at Berkeley and Columbia Graduate School of Journalism. Heather, wonderful to have you join us on the panel today. Thank you for your time and expertise.
Thanks for having me.
Absolutely. Turning now to Lon Juricic, President, Founder, and Editor-in-Chief of StreetInsider.com. After founding StreetInsider.com from a spare bedroom in 1999, Lon built the company into a leading financial news publication with over 11 million website visits annually. He leads a newsroom that thousands of investment professionals around the globe rely on daily for breaking stock market news and information. In addition, his firm has bridged the gap between web development and financial markets to create cutting-edge tools that are easy to use and have set the standard throughout the industry. He's a frequent guest and has been interviewed in many major media outlets to include CNBC, The Wall Street Journal, and Barron's, among others. Lon, congratulations on all you've done. It's a delight to have you with us on the panel today. Thanks for sharing your expertise.
Thanks, Mark. Appreciate it.
Absolutely. Well, with that, Tom, how in the world do you put a capstone summary on the deal markets in 2020? Over to you for some insight.
Well, thanks, Mark. Again, it's a real pleasure to be here this morning to talk about what has undoubtedly been one of the most fascinating M&A markets in many, many years. I think if you look at the graph here, obviously you can see that there was a dip in overall activity year on year, about 21% in fact overall. I think the hard data only tells half of the story. What was really a gripping story that had a twist and turn at every chapter, mirroring what happened in the wider world. So if you think back to January 2020, a year ago, at the start of last year seems, almost naive now, but our biggest concerns for the M&A market at that stage, after a really robust 2019, were probably the election on the horizon, uncertainty around that, and the geopolitical instability in the Middle East with the Iran tensions, etc. And then as the first quarter progressed, we obviously saw what was happening in Asia. And towards the end of the first quarter, the reality of COVID-19, the pandemic, and what it meant for not only for the M&A market, but for our lives, that really sunk in. And I think that had a ripple down effect into the M&A market. The deal makers were wondering, well, how can we get a deal done? How can we do that without physically meeting people, without being able to conduct due diligence? And things like Zoom and other virtual tools are really in their nascency at that stage in terms of their application in the M&A market. So Q2 really, that had a big impact, a shuddering halt really on activity overall. I'd say the M&A market went into hibernation in the second quarter. If you had a deal process, you were probably either putting it off, putting it all together, or you were renegotiating terms between buyers and sellers. So really hibernation. Obviously in Q2, we also saw the CARES Act, the impact of stimulus money coming into the market. A lot of companies did pipes, rescue financing. People were really focusing on bolstering their balance sheets, weathering the storm, rather than thinking about M&A. But then everything changed in the third quarter. So I think back actually to probably towards the end of June, we started to see, and I started to notice some auction processes that had been pulled in the first and second quarters starting to be relaunched again as confidence came back. And that really led to, the title of the webinar today, Full Throttle. So the third and fourth quarters really saw a tidal wave of activity, for want of a better expression. We actually saw, according to Mergermarket's record, the strongest second half on our record, especially in Q3. You're talking about over this two quarters, a 200% increase from the first half. I think there were several factors at play explaining that. So first of all, some sectors proved to be resilient and pandemic resilient. For example, healthcare, technology, we'll obviously be talking about those a little bit today. And then other sectors that came up in the auction market, for example, personal care, pest control, home improvements, all of those things which, we're seeing increased demands, all those sectors seeing increased demands. We saw that play out in the M&A market. At the same time, you saw the financing markets wide open. Private equity buyers, for example, had more options for financing in Q3 and Q4 than at any other time in recent memory. And they really took advantage of that. We saw a surge of private equity activity. And you saw all that pent-up demand as well. And another factor that really explained the rush to the exit was the election. Sellers that were mindful of a potential change in administration and mindful of a potential change in the tax regime, rushed to the exits. So I think that was really the story of the year. You also saw a slew of mega deals as well, interestingly. So for example, Salesforce Slack was one which is very kind of thematic given the home working environment. So all of those factors combined did contribute to a strong end of the year and remain in place as we go into 2021. Last but not least, we saw the rise of the SPAC, which we're going to talk about a little bit today. Record amount of the SPAC issuance. It's going to be a major player. So I think 2021, interesting because it starts with the conditions which point to a robust year. We'll talk about that further into the webinar today.
Fantastic overview, Tom. Thank you for that. Lon, I want to bring you into the conversation and perfect segue on the deal, large deal market, the mega deals. Talk a little bit about your observations from a capital markets and from an investor perspective on M&A 2020.
Yeah, thanks. That was a good intro, Tom. And I guess my main point I want to focus on is the stock deals are back, and they were just back in a humongous way. Look at all the top deals. They involve either all stock or a component of stock, a big component of stock. And the stocks have held up relatively well too. So a lot of times the company don't want to issue their stock because immediately the traders would start selling their stock down. But stocks have held up relatively well, and that just really positions them. And not only can companies use cash on their balance sheet, but they can also use their stock to leverage the market and outbid any financial buyer in the market. So if you look through the list, in November, you see S&P Global, they acquired IHS Markit. It was a $44 billion deal. That was all stock. And S&P stock's down a minor 7%. And that's, considering the size of that deal and the ARBs that, probably put pressure on the stock, that's just really a minor blip. AstraZeneca, they acquired Alexion in December. That was a $39 billion deal. That was 2/3 stock. AMD acquired Xilinx, and that was a end of October deal. And AMD stock's actually up 12%. So the market's really taken that deal and what AMD has done and bid up that stock even higher. And then, of course, I think Tom mentioned the Salesforce deal. They acquired Slack. That was a third in stock, while Salesforce stock is down 12% or 17% since that deal was announced. I think that's more to do with the sell-off in the tech stock, people profit taking after just a massive year. Salesforce stock was just up huge last year. But, it just goes to show that people are using their stock well, and they're also keeping that cash on their balance sheet. So they're weathering the COVID storm. And, buyers are using the stock effectively as leverage, and the sellers are accepting of the stock. So, the seller has to have confidence that the stock they're taking is going to hold value. So I just think it's just so important to see these deals go through in stock. And you just didn't really see that over the past several years. We just seen it massively in Q3 and Q4 of last year. And I just can't stress that point enough. Just how important it is. There's another point when you're looking back at 2020. I think Tom mentioned it briefly. Look at the Zoom deals. Everything was happening over Zoom. And no one ever expected that you could do a $44 billion mega deal over video conference like you and I sit here today. But there just wasn't the opportunity to meet in person. So you had these deals just happening just over video conference. And people even thought that it was even more efficient. So instead of all the travel time back and forth trying to set up schedules, people had a better opportunity to do deals, to talk and work through these things and all the due diligence required for these deals. So there's even an argument to be made that the reason we had such a huge push towards the end of the year because deals were happening faster. And once people had confidence in the market, they could get deal from start to finish faster, and why you potentially had that big rush at the end of the year. So that's what I would like to focus on and things that I see for 2020, and hopefully it will continue into 2021.
Lon, really great insights. Thank you for that. And just for our participants here, I would like to pick up on Lon's comment and direct you to the M&A Leadership Council website. We actually did a couple of webinars last year, one of which was executing M&A post-COVID, where we really took a deep dive into how organizations are doing strategy, targeting, due diligence, integration, change, comms, trust building, et cetera, to really execute the full program of M&A from start to finish. So, Lon, I appreciate your perspective because I've never really thought about the impact on the pace of deals and accelerating via this format. So thank you for that. Heather, I want to quickly get you into the conversation, and can you provide a little bit more sector breakdown from the general observations and the overall macro trends for us if we look at this slide to begin with?
Sure. I was going to get to that, and I can start with the sector breakdown if you wish. So according to Mergermarket data, in 2020 the most active sector was technology with about 27% of the pie, followed by pharma and healthcare at 15%, and industrials and financial services both had about 11%. If you don't mind, I'll come back to that in just a moment. Okay. So I think later in the presentation, Tom will touch on some of the private equity trends. So for this portion, as I look back on 2020, I wanted to focus a little bit more on what the strategic acquirers were up to. And typically, as you know, in an election year, there's often some caution, especially around September, creeping up towards the end of the year when people are not quite sure who's going to be president and what the policies will shape up to be. and that was so that's typically the case. But in this third quarter, as Tom pointed out, there was just a surge of activity. So it seems that the impact of the pandemic was more influential than hesitation about who might be president in 2021. And what we saw was that financial buyers were more bullish during this period. So after the sort of shock of the first couple quarters, in the third quarter, private equity came roaring back. And strategic buyers, their activity was down by about 11% compared to the same period in 2019. So what we saw through our data was that it looked like the strategic buyers had cold feet, or they had less risk tolerance than they normally have, for probably a lot of reasons. That was one thing we noted in our data, is that typically the strategics make up more deals, but they really slowed down while the financial buyers are really speeding up. Another conversation, or I guess topic conversation that we had throughout 2020 was, and you both mentioned, is how to get deals done in that virtual setting. And one tool that was being used quite a bit was the use of the earnout. So that's something that can be used to help bridge the valuation gap between what a company might be worth today and what it could be worth in the future. So if a company is temporarily suffering due to the pandemic, but it might be doing very well in a few years, deal makers were using the earnout to help bridge that gap. And what we noticed is that the length of the earnout was increasing. So rather than being a typical 1 to 3 year earnout, some of them we saw were as long as 10 years. So Ryan Reynolds, the very handsome actor, for example, has a gin company. It sold to Diageo, and in that deal there was a 10-year earnout with about 82% of the value of the deal. So we saw both the length of the earnout and the percentage of it increasing quite a bit, which was interesting. Another theme, I guess middle market also was a fan of the earnout, especially during the spring period. So flipping back to the sectors, as you mentioned, Mark, technology was absolutely the most active for obvious reasons. And as both Lon and Tom referenced, the Slack Technologies deal, that was a $25 billion transaction. And I think a lot of people saw it as Salesforce seeing Microsoft Teams as being a threat. Our own organization is even switched from Slack to Teams. And so maybe it was kind of a defensive play. And Salesforce paid about 25 times Slack's estimated 2021 revenue, so huge multiple. Another thing that you might not know is I'm based in the San Francisco area, and when you walk along Salesforce Towers, it's called Salesforce Park, it's like the High Line of New York City, you can actually see into the windows of Slack. So the two companies are smack next to each other. So I thought that was interesting because there's no relocation required in terms of deal integration. It's going to be the easiest thing in the world because they are literally right next to each other. And my husband thought it was funny, like lazy deal making, right? Just like guy across the street. So I thought that was interesting. When I looked at a map, I just wanted to confirm they are absolutely like smack next to each other. So that's an interesting deal for so many reasons. The second largest sector was healthcare. I think Lon will talk more about maybe the biopharm element of that. But a big theme there is the virtual care, the delivery of care, through talk to your doctor over a computer rather than going in for a site visit. And Teladoc paid about $14 billion for Livongo Health. So that just speaks to the value of that, both behavioral health and delivering care through through an app or computer. It's really going to be key going forward.
Excellent, Heather. Thank you so much for that. Panelists, anything else on 2020 insights before we get into 21? All right. Well, let's shine our headlights a little bit farther down the track then, and begin to apply the data sets, the insights, and the trends to what deal makers ought to be thinking about in 2021. And Lon, for this, I want to turn it over to you to tee up your outlook for 21.
Yeah, I think when we look at 2021, we are positive. We think we'll see similar activity that you saw in Q3, Q4, and really, I want to focus on what I call the 3 C's. That's cash, confidence, consideration. First C is just cash. It's just everywhere. Cash is just, it's literally, they're printing money like crazy. The money supply, M2 is up 24% since March of 2020. You just look at Bitcoin, gold, real estate as examples of people trying to hedge against inflation and the ballooning money supply. The Federal Reserve is supporting the debt market with its infinite bazooka and keeping rates low, which also adds to deal activity. Just last week, Fed Chairman Powell was asked a serious question about helicopter money. Now, that was something when Ben Bernanke was Fed Chairman, they were joking about, and that was actually a serious question in an interview last week. Corporate balance sheets are robust; they're flush with cash, and as I talked about before, companies were using their stock instead of their cash for deals. The SPACs, huge, every day coming to market, 5, 6 deals coming to market. The P firms are flush with cash. So cash is literally everywhere. I mean, if you look at the customer itself, if you look at JP Morgan's conference call, they talk about how the customer is sitting there with tons of cash in their checking accounts, in their savings accounts. So cash is literally everywhere. So that's my first C. Cash is king, cash is everywhere. The second C I like to focus on is confidence. And this is probably the most important C, because just cannot do deals without confidence. Management on both sides need to be confident in deals. Specifically, the buyer, they have to, look at the market. Where do they see trends? What's going on with the coronavirus? And I think the visibility with the vaccine creates this, it lifts the fog of coronavirus. So when companies and management are looking out, they can actually see something instead of just seeing this gray fog. They can see into the future. They know that the market are coming back to somewhat of maybe not 100% where it was, but they can see some visibility, and that's because of the vaccine, and it's creating confidence. And the last one we talked about that in 2020 is consideration. If companies can continue to use their stock as currency, that just adds to cash, adds to using the debt market. It just adds to the deal activity. It just a tremendous opportunity for companies to leverage their stock in a rising stock market to do deals. So, we focus on look at those 3 C's. In addition to that, I just want to focus on a few areas. We've talked about how these 3 C's can be applied and what the 2020 outlook would be. So biopharma was humongous in 2020. And I think that's going to continue to be a hot area. We just had the JP Morgan conference last week, and that's always a hotbed for deals. Oncology, you see any cancer drug, they're getting taken out. Even phase 1 trial deals are getting taken out. So they're not only focusing on later stage drugs that have been proven in multiple phase trials, they're going for phase 1 trials because that's how hot that area is. Another area is semiconductors. If you look through the leaderboard last year, semiconductors just littered with the top deals, and I think that's going to continue. On semiconductors, one company specific that we see as a takeover target for this year, packaged goods. Now, these packaged good companies, they levered up their balance sheets several years back. They were doing all kinds of deals, so they were kind of out of the market. We see them coming back big because they've got their leverage ratios under control. So Conagra, Campbell's, General Mills, Smuckers, they'll be on the prowl for deals. We're going to talk about SPACs more, but there's just one SPAC in particular that I'd like to highlight. That's Bill Ackman's Pershing Square Tontine. They are lining up for a mega deal. So you would probably see within the next 6 months a unicorn go to Bill Ackman. So that's one deal we're going to keep an eye out. Anything cloud, work from home, direct to consumers, those are going to be hot spaces for this year. So again, 3 C's, we're looking at cash, confidence, consideration. It's going to be a robust market in 2021. Thank you.
Excellent tee up, Lon. Thank you for that. Tom, I want to get you back into conversation. Talk to us a little bit about your viewpoint for 21.
Yeah, thanks, Mike. I think Lon, really summed it up nicely there. The conditions are in place for a really strong year overall, notwithstanding the political instability that's out there, the continuing surge of coronavirus, which governments are struggling to get under control. If you look at the kind of fundamental conditions for a strong M&A market, they are in place. Just to highlight a few of them, in particular, the financing markets, which I talked about before, being wide open. You combine that with the surging demand and a very heavy dose of pent-up demand, and you have conditions for a really strong market. So I'd like to hone in on a couple of the key themes that we see and a couple of the protagonists that will be really, really predominant in this year's market, which we've done a lot of work on at Mergermarket, and those are the SPAC market and private equity as well. So of course, 2020 was the year of the SPAC, and everyone is talking about SPACs given the sheer amounts of issuance. You pick up the papers, the financial press, and you'll read about SPACs. We had a really interesting commentary piece last week, and I picked out a quote from it, which is interesting. It said, the SPAC started 2020 as lambs and they ended as lions. That simplifies it a little bit because, in fact, the SPAC trend had been gathering momentum prior to last year. In fact, if you go back to 2016, on an annual basis, we'd seen an uptick in SPAC issuance every year for varying factors. But last year was the year where we saw a 6 times increase in SPAC issuance over the previous year. We saw over 250 total issuances. So it really was the year of the SPAC, and as Lon was saying, SPAC issuance are continuing at a clip of about 5 a day on many days as we go into the new year, and we hear that the requests and the demand for filings continue to pile up as well. So it's not going away anytime soon. Obviously, at some point there'll be a digestion period, and there might be too many SPACs. Maybe we're getting towards that now. But at the moment, I think the interesting question for the M&A market is, what does that mean for the market overall? You have hundreds of vehicles flush with cash looking for deals in the pockets that Lon and Heather were talking about. And I think it means 2 things for me. First of all is an increasingly competitive playing field. So we've talked about the different players in the market, the private equity, the strategics. Within the SPAC market itself, there's intense competition for targets. Mergermarket, we cover ongoing auction processes. We speak to companies that have been approached by SPACs. One CEO told us they've been approached by a dozen SPACs. And in fact, there's a term that's used in the market, the SPAC off, basically, which is essentially SPACs competing for targets. I think that's one area. You're going to see that intense competition play out as the SPACs look to de-SPAC, when they find an acquisition target within that defined time period of 2 to 18 months. So that's going to be very interesting. At the same time, it's a seller's market. So sellers can get more demanding with terms and valuation that they're asking from the SPACs. I think that's very relevant, not just to SPACs, obviously, but to anyone who's in the M&A market looking for a deal, that you've got all of this capital out there looking for targets. So the second area I'd like to just highlight is private equity. We touched on that a little bit. So last year was a very interesting market overall for private equity. You can see from our graphs here, just look at the Q4 volumes, for example, in the US for those buyouts. But overall, globally, it was the biggest year for private equity buyout activity since the financial crisis. So it was a very strong year. And that was driven obviously by the fact that private equity firms, we hear about the dry powder, the 1.7 trillion was the last figure I heard in terms of the global dry powder available to private equity. And I think there's going to be a lot of activity this year, a lot of pent up demand and capital to deploy. You'll see that play out, in terms of buyouts and exits. And also I think private equity firms looking to more creative strategies as well to deploy their capital. For example, taking minority stakes or looking for co-investments. At the same time as well, it's not just buyouts. You look at add-on activity surged actually last year in the last half of the year. I think that's going to be a big theme as well. Platform companies of private equity doing add-ons. So I think all of those things point to a very active year private equity as well. In fact, we talked about the financing market, but it's certainly seen as a market where there are more opportunities for private equity than many times in recent memory. So I think those are a couple of themes that I would certainly be looking out for this year.
Excellent. Tom, thank you for that. And Heather, let me segue to you and get some of your insight, sectors, deal types, et cetera, for 21.
Sure. So I think when you try to predict trends for a coming year, you typically, they don't really come out of nowhere. They tend to build on the momentum that was gained in the prior year. Obviously, that was not the case in 2020, because you remember back in January, everything was about the experience economy, and right after that, restaurants, travel, hospitality all crashed. So I don't think anyone could have predicted what occurred in 2020. But I do think it's safe to say that technology is going to be a continued theme in this year. So themes of virtual healthcare, cloud software, this urgency to upgrade technology will continue to drive deals. And this is across sector. As you know, technology is overlapping with everything from healthcare to industrials to consumer. And some of our tech reporters recently did a report where they highlighted some of the top tech sectors for 2021. And one was in industrial robots. And this was kind of interesting. If one thing that we saw when we couldn't get our toilet paper, or we ran out of chicken at the supermarket, the supply chains were a disaster. Even over the holidays, if you're trying to get packages shipped, you had to do it 4 weeks early. So I think anything used in the warehouse setting and e-commerce is going to do really well. So we also heard that this could be an active space in the mid-market in particular. So any industrial robotics for the warehousing type space. Second one that was interesting is technologies used to manage foot traffic. So, as you can see with the virus numbers, this doesn't seem to be going away anytime soon, and companies, retailers still need to monitor how many people are in their shop at any one time. So technologies that help count people in a particular room are seen as hot targets. And there's one that we've marked out, it's called density, which detects the number of people in a space. So that's an interesting area to look out for. A third is mental health. I touched on that with the Livongo deal. Everyone isolated, stuck at home. There's a lot of mental health issues. There's continued, substance abuse issues, and companies are finding ways to address this online, like speaking to a therapist over your phone. And one that we see as a potential target in this space is called Talkspace, and that provides online therapy, just as an example. A third area, and this is one that did not do so well in 2020, so energy, oil and gas deals were not abundant last year. There were a few big ones towards the end, but the background to that, but it's a kind of a mess. But there is growing interest in what they're calling the energy transition. So even companies like Shell, remarkably, are saying that they want to be carbon neutral by 2050, which seems like a huge goal. But part of the way that they're trying to get there is by using technologies like hydrogen, in addition to solar and wind and other renewables that are more widely used at the moment. So in the hydrogen space, one company to look out for is Plug Power. They do green hydrogen, and they just raised $1 billion in November. So that's an area that I find personally really interesting. And then both Tom touched on SPACs. In the renewable energy space, there have been quite a number of SPAC vehicles buying electric vehicle companies. So Fisker, as an example, was sold to a SPAC backed by Apollo, that was an electric vehicle maker. So there's the SPAC space is they're even dipping into the renewable energy space. Third, looking forward to 21, we're closely following the plant-based foods movement. So this was something that was in existence before, but the success of Beyond Meat has led a lot of people wanting to ride on those coattails. And a few that we're looking at is Oatly. They make oat-based milk, which is really good in a latte if you haven't tried it. And they're expected to IPO this year. Impossible Foods is another one. They make plant-based burgers like Beyond Meat, and they're also likely IPO bound. And I think these food trends are interesting for a couple of reasons. I mean, one is the change in eating habits. So it's not just vegetarians buying them, but also omnivores just want to try something new or eat less cholesterol, consume less meat. And it also touches on ESG trends. So having fewer cattle could mean lower carbon emissions. So plant-based foods are interesting for a number of reasons, and it's probably going to drive a bit of ECM activity this year. And last, I just want to point out with big tech, I think we're going to be looking out to see how big companies manage to get even bigger. Again, with that Salesforce Slack deal, apparently companies like Microsoft and Amazon may not even have been able to do it due to potential antitrust concerns. So as we welcome the new administration and see what their policies will be, I think everyone's going to be keen to see if there will the Biden-Harris administration will be, I guess, how they feel about trust busting and how that'll affect big tech. That's another major theme we're looking out for.
Excellent. Thank you, Heather, and panelists. Great job on that. Tom or Lon, anything to add to 2021 insights before we navigate to our Q&A session?
I think you really, going back to the SPACs again, just a couple points I want to make. A couple weeks back, SoFi, which is a massive fintech company, decided that they're going to go public via SPAC. What trend that I noticed, and I think Heather mentioned this, is that EV companies are coming public via SPACs. I think that has to do with Tesla. How hot Tesla is, so everybody is on that trend, and the stocks are just blowing up. So as soon as there's a rumor that XYZ is merging with this SPAC, the SPAC's up 100%, 200% that day. So I just think, the ability to follow trends. So companies, that have these trends going, if they're able to quickly go to market, they can take advantage of it. So, anyone, it's in an EV space, Tesla's hot. All right, let's get to market. Let's merge with SPAC. That quickly, instead of going through the IPO process, going through a SPAC, reverse merging, and able to get to market quickly, take advantage of the hot market. And that's another, it's something to be to watch. There's just so many SPACs out there with so much money. They're just sitting there waiting, waiting for company management to give them a green light to do the deal. So, any hot sectors, that will be probably where the SPACs will be focusing.
Fantastic. Yeah, spot on. Panelists, thank you. Let me go ahead and segue to this next section then. And as we're doing that, panelists, I want to call out to your attention the questions pod on the right-hand side of your screen under the GoToWebinar control panel there. Please be thinking about questions that you would like us to address and discuss with and among the panels, and we'll take as many of those questions as we can. Participants, as you're thinking about your questions, and while we're giving the panelists a little bit of a break, let me take this opportunity to just share a little bit more about the M&A Leadership Council for any of those of you that are joining us today that are not familiar with us. First of all, we're an educational consortium. We're comprised of global professional services providers, experts and practitioners in the M&A community that are deeply dedicated to helping acquirers of all types and varieties really take their M&A game to the next level. We do that through a variety of best-in-class educational events, research and publications, and a first-of-its-kind certification called the Certified M&A Specialist. Over the last 11 years, we've been honored to serve over 700 global companies, training over 4,000 participants, executives, M&A deal team members in all shapes and varieties of acquirers, industry sectors, and deal strategies across the entire life cycle of M&A. We do that with robust expertise, discipline, and a view on practicality, what really works in the line of fire to improve business results as you execute M&A. On our council website, macouncil.org, you'll see a variety of upcoming training programs as well as future webinars. And if you're interested in exploring this for you or for others on your M&A team, please be sure and either reach out to us. We can put you in contact with other participants, share results from prior events. And of course, if you're interested in attending, be sure to use that registration code Throttle30 for a 30% discount on any of these programs. Now with that, I'm seeing a number of really good questions coming in. So what I'd like to do, panelists, with your permission, is go off of screen share for just a moment. so we can encourage a little bit more interactivity and ideal screen views for our participants. And what I'd like to suggest is that we tee off. Tom, let me give you one that's come in that I don't think we've addressed in much detail, but at the outset of 2020, we certainly anticipated divestitures to have a predominant role in the overall mix of deals for 2020 and going forward. Here's a question from Tom. He says, do you see corporate divestiture activity remaining strong in 21? And what are some of the main reasons corporates may choose to sell non-core assets?
Thanks, Mark. It's a great question. So corporate divestiture activity was strong last year. So we talked about a little bit about the kind of environment in Q3, for example, Q4. So we saw, in Q3 alone, $7.3 billion of divests announced. And in terms of Mergermarket's work in tracking companies that are either looking to divest or in the process of divesting, we're definitely seeing a lot of activity there. So I do think, yes, it will remain strong as we go into the new year. And I think we're seeing in a wide array of sectors currently divestiture activity taking place in industrials, chemicals, technology. It's really across the board. What are the drivers? Well, I think there are several key reasons that triggers the company might look to divest. Obviously, to deleverage in this kind of environment where some companies may need to shore up their balance sheets, they may need to pay down debt. Selling non-core assets is a way to do that. We've also talked about the kind of digital transformation and how COVID has accelerated that. The corporates across the board looking to invest in new technologies and focus on really what's core and look to shed what's non-core and doesn't fit into that strategy. So that's another key factor. Some assets may not be in the right home, and that's an opportunity for private equity. For example, let's say a unit in a larger corporate has not been performing over multiple quarters. Perhaps private equity would be a better home for that to help drive a turnaround. Shareholder activism. There's been a lot of talk about shareholder activists becoming bolder this year after last year maybe not willing to be seen as insensitive as during the pandemic. There's a recent article I read on that. But I think M&A demands, including selling assets, is always a big part of the activist agenda, and again, that's a big factor. And the other one is companies that have been involved in M&A deals. So, for example, we talk about some of the mega deals that have occurred last year and also in prior years. Companies digesting mergers will be selling as well. So I think all of those things point to a continued active environment for corporate divestitures this year. C-suites that may be evaluating assets, have been contemplating selling for some time, maybe pulling the trigger on those this year.
Excellent, Tom. Thank you. Heather or Lon, any other comments on the divestiture outlook? All right. Lon, I'm going to go to you for this next question then, and we have to get into this, and I think with your coverage on streetinsider.com, this will be a good one. This comes in to us from Scott, who says, let's bring politics into the deal market discussion. What potential impact do you foresee in the M&A markets under a new Biden administration and Democratic control of Congress? Some of you have alluded to that briefly, but Lon, take us through that. How do you analyze that?
Yeah, it's going to be challenging. There's no question about it. But, I think under the Trump administration, it was also challenging. Usually would think in the Republican administration, it's going to be easier to do deals. But, with the way Trump handled China, the China deals were killed. NXP's deal got killed because of the China, the way they was handled. You have the TikTok situation where basically unilaterally said, we're going to make that company be taken over. So there was just challenges all the way around. So I think that's going to continue with the Biden administration. So I don't see too much difference. I see there's going to be, similar challenges both years, but, ways to get deals done, but just not slam dunks.
Okay, very good. Other panelists, thoughts or comments on that?
Is the question related to the change in administration?
Yes. And any implications of that and Democratic control of Congress for M&A markets?
I think the one thing that came up, at the end of last year was the concern about capital gains taxes increasing, but now that we're already into 2020, maybe we'll, that could be an impact. There'll be more of a cut taken due on those capital gains. But from what I've heard is from some large leading PE executives that they expect a V-shaped recovery. They seem pretty optimistic about where things are going, and I think fears may have been if there were maybe someone seen as a more progressive person elected that policies would change drastically. But overall, I think people think there won't be drastic changes despite a new administration. So that gives deal makers more confidence because they feel like they sort of know what they're going to expect. So yeah, I sense some optimism and not as much fear. So sorry.
No worries. Thank you for that. That's very helpful context. Tom, let me go on to this next question. We have a question from Steve, who is asking for more information about VCs. Now, certainly the SPAC market is really predominant. That's going to be touching many, many deals, as each of you have effectively pointed out. But Steve's question is with regard to VCs and exit activity continuing in 2021. The question reads, what options do these companies have, VC-backed companies that is, to exit, especially if they're looking at public markets? Thoughts on that?
Yeah, I think that's a good one. I think Lon touched on that definitely. The fact that the SPAC option is definitely a compelling one for some of these companies. I think what I would highlight is just the level of optionality that some of these companies have now to access the public market. So you have the traditional IPO route. We're expecting a strong IPO market again this year. We saw an incredibly strong IPO market last year. So that will continue to be a strong option. SPACs, we talked about the sheer kind of volume and amount of money SPACs have raised and looking to deploy this year, often in late stage venture capital firms. So if someone wants an accelerated timeline, partner, an investment partner, etc., those are some really strong option and it's a really strong route. And in fact, many of the executives that we speak to at some of these VC-backed companies considering both of those options. So those are two compelling ones. At the same time, companies also have the direct listing route. We saw a couple of companies look at that option last year, and now companies have the ability to raise capital following some regulation changes with a direct listing. So that's another avenue as well. So I think there's just a really increased level of optionality for companies that are looking at the public market. But I think probably the IPO and the SPAC routes are probably going to be the ones that we talk about the most this year. But again, there's just a lot of options out there for those kind of companies.
Excellent, thank you. Heather, you mentioned ESG. Lon, you cover consumer products and companies that are very, as well as the sector at large. I'd like to probe into a little bit more around the ESG impact. And a question has come in from Doug, who asked, ESG is beginning to transform businesses as major corporations are increasingly committed to sustainability through a variety of environmental, social, and corporate governance factors. What are some other ways ESG impact may affect M&A markets in 2021? Really good question. Heather, you want to take the first shot at that, and then Lon will go over to you for your thoughts.
Yeah, I think it certainly impacts the types of targets that buyers are looking for. I mean, ESG is pretty broad. It covers a lot of things, but everything from diversity to, what's good for the environment. But in the case of food, for example, I mean, even down to like what's healthier. I think everyone wants to do what's best. It's not just good for the consumer. I guess it's following consumer demand. So if Campbell's Soup doesn't want to sell salty foods, or if Mars doesn't want to sell as many sugary products, they're going to buy more lower sugar, healthier snacks, or lower sodium soups. I mean, we've seen that in the types of targets that big companies are chasing. And again, like going back to energy, that's huge. I think people money is sort of moving away from oil and gas, and it's really flowing. We've seen this in the past. Energy can be very cyclical, but it does seem like this could be a longer lasting theme of moving into energy sources that are lead to lower carbon emissions.
Fantastic, thank you. Lon, any other thoughts on that?
Yeah, I think people need to get their ESG records in order. I think if you want to be acquired, you can't have a bad history of ESG. So that helps. The companies propel this initiative. I mean, even NASDAQ announced that they want 2 women on the board of the companies that listed on NASDAQ. So everyone's making major moves this way. So if you're a company that's not following practices for ESG, you really better get yourself in line if you want to sell the company eventually. And I think boards will take notice of this and try to get themselves in line. Also just the social aspect with COVID and all the people struggling right now. I think companies can't really come in and do slash and burn like they may have done before, where they're coming in and firing thousands of people. So I think people, companies really need to be cautious about that. If that's part of their plan, is they don't want to look like they're creating more of a problem. So I think that social aspect of it is important too, that the slash and burn is a thing of the past.
It's a really interesting insight on part of the corporate acquirer's brand, how they approach difficult decisions, footprint reduction, headcount reduction, et cetera. So spot on. I can't wait any longer for the competition question. I've been seeing the questions come across, and there's a number of questions about the amount of cash in the market, as you all have effectively identified, and the resulting competition for deal targets out there. So a couple of questions on this. Number one, just give us your thoughts on the overall trend, the amount of cash, the multiple buyer potentials for each respective target. Who wants to take that? What do we think will happen in a highly competitive bid situation? Thoughts or comments?
Unmuted.
Yeah, I can take that. I think the strategics have the upper hand because they can use their stock. If the market's going to be accepting that take stock deals, then companies that can use their stock have leverage over a financial buyer all day long. So I think that's just one aspect to look at is strategic definitely have the upper hand here at the end of this year.
Yeah. Heather or Tom, comments on that? Who might have the predominant hand going forward in 21 because of the cash and the competition factor?
I mean, I like Lon's about stock transactions. I think that's a really good point. I also point out that it's going to be really high multiples, so you're not going to get anything that's considered COVID resistant. This is a big theme. So, I mean, like a cloud software company, anything that did well during the pandemic is going to be a super hot target and will go for a very high multiple. That's some themes I've been seeing. Tom, you can speak to the cash question.
Yeah, I mean, I think it's an interesting question. I'm not sure if I'd say who would have the upper hand. I mean, it obviously depends on the situation and the areas of the market. I think what I would say is that you'll see all 3 of those kind of major categories of buyers that we've talked about being very active. So, Ron and Heather have talked about strategics. Obviously, I talked about private equity, the record amounts of dry powder, and ready to deploy that. At the same time, you've got all the SPAC capital as well. So I think there'll be intense competition, but I think that each of those categories of buyer, will be very, very active in respective areas of the market.
Excellent. That ties into this next question that we've received from Marcos, and it's about PE exits. Tom, you've talked a lot about PE buyouts as well as exits. Marcos's question says, any insights on PE exits? Will they become more inclined to hold companies for longer or shorter periods of time? Tom, you want to start us off on that?
Yeah, I'll kick us off. So I think again, it really depends on. We've talked about the different sectors, those that were pandemic resistant. What came up in the market in Q3 and Q4. I think that's probably a good indicator because a lot of those companies were private equity backed in healthcare, technology, some of the other areas I mentioned earlier, in the kind of consumer industrial space, which were more pandemic resistant. It really probably comes down to valuation. So where you can get a good valuation, I think obviously you're going to see more inclination to exit. What we did here, I think towards the end of last year, was that there was kind of the approach to valuing companies by private equity. They were being quite cautious, and essentially sometimes being a little bit wary of just looking at the COVID related financials. Instead, going back to what were the 2019 financials, looking at different metrics. If it's a tech company with recurring revenue, so I think it's that's an interesting question. I think the other interesting element, which is kind of related to that, but not just on the private equity side, is distressed M&A. So if you think back to this time last year, I think in Q2 we expected a lot of distressed M&A, and then obviously we saw the M&A market really taking off as a whole in Q3 and Q4. So we weren't as probably focused on distressed activity. There's definitely going to be more restructurings again this year, and I think as we progress, we're now kind of a year into the pandemic, pretty much. Maybe companies that will be more willing to look at selling as part of their options if they're on the distress side. Whether look at things like dental, anything that requires in-person meetings. To name kind of one area where we've covered recent distressed activity on the M&A side. So
yeah,
I think that's going to be something to look out for as well.
Tom, really good insights. And just tying into that, we did a webinar last year on due diligence, and we really queried how much substance is there behind the meme EBITDA, earnings before interest, taxes, depreciation, and COVID. And the clear consensus was those kinds of add backs and valuations are more the exception rather than the norm. But what we had seen, to your point, is COVID impact has actually validated and in some cases de-risked a lot of pure performance and solid organizations that made their valuation more premium than before COVID. So it's been very interesting. I'm going to close out on this one question. Nick has asked us a question that I think, Lon, you started us out on earlier, which is the impacts on COVID. And let me paraphrase this just slightly. To what extent do you anticipate remote-oriented M&A strategy, targeting, and operations will continue post-COVID? Any ventures on that and the implications for continued deal pace and flow?
I guess I could start there. Yeah, I think that you'll probably still have the meetings, the handshakes, looks in the eye once these restrictions lift. But I also think that you're going to be able to do a lot of work virtually. So I see both happening. People want to get out there and hit the road. The bankers want to go out there and hit the road. They're chopping at the bit to get out on the road again. But also, again, people have realized all the efficiencies. You can use video conferencing and Zooming and things of that nature. So.
Yeah. Heather, Tom, any other thoughts? Yeah, please.
Yeah, I've heard there's definitely a lot of conversation about this. And with travel, I heard the CEO of Workday, for example, said that he expects travel to return to about 75% of previous levels, just throw a number out there. And in terms of the working from home situation, he and a couple other people we've spoken to mentioned that they thought having their workers work from home 1 to 2 days per week could become the norm. So I think there will be some permanent changes as a result of this, and absolutely they're going to continue to use virtual conferencing more, particularly for the type of scenario where you might fly all the way to Abu Dhabi for one meeting. That won't happen anymore. It's more likely that you'll see fewer of those one-off, long-distance, 1-hour meetings, and those kind of things can be conducted over a conference call or a virtual setting.
Heather, excellent capstone for a fantastic webinar. Thanks to each of our panelists, Lon, Heather, and Tom. Tremendous insights. And I want to go back to the framework, Lon, that you started us off with, the 3 C's. We added 2, cash, confidence, and consideration. We added competition. I'm going to add a 5th C to that, and that is capability. And what I mean by that is, in light of the cash, in light of the deal activity anticipated in 2021 and the outright competition across many of these sectors, a common theme that we hear from even highly experienced acquirers is the need to take their internal M&A capability to the next level of success. How do we do more deals, faster deals, overlapping and parallel deals, different deal types, more global deals, more complex deals, and more simultaneous transactions all the way through at various phases of the life cycle? And that brings us back full circle to where we started. That in part is a big mission for the M&A Leadership Council, is to help acquirers of whatever industry, sector, or type get their M&A game to the next level of success, to view it as a strategic business process for growth, not merely as a one-off transaction. So with that, I want to say thank you again, panelists, for an excellent conversation. We deeply appreciate your insights and expertise, and we look forward to connecting with each of you participants at an upcoming M&A Leadership Council learning event. Stay safe, stay well, everybody. Take care. We'll see you again soon.
Thank you.
Thanks, everyone.